Hi guys, Tim Melvin here. We haven't done any video content here for you guys in a hot minute or maybe even a couple years or two. But I kind of wanted to jump in, start getting a little video content. We're going to head out when we have time a little later this month and invest some money in a little better video equipment than we're showing up on today. But we'll start with what we got and move from there. Um, Obviously, if you've been sitting around, the markets are just getting smacked around pretty good right now. Um, the Fed had originally said, inflation is going to be transitory. We're going to be able to deal with all of this issue. We've got the proper tools at our disposal. And every time those numbers come in, they're coming in at 40-year highs. Guys, the last person to try to dance with the inflation dragons was a guy named Arthur Burns. He was the Federal Reserve Chairman appointed by Richard Nixon in the early 70s. Prior to the 1972 election, even though Nixon had this in the bag pretty much, he came up and he asked Mr. Burns to, let inflation run a little hot. We can deal with inflation. We just can't have the economy slow down going into the election. Now, of course, that turned out to be one of many missteps and blunders that Richard Nixon made prior to the 1972 election. This actually was one of the more permanent ones because once those inflation dragons got out of the cage, Burns couldn't get them back in, and Paul Volcker had to take interest rates up to over 20% in order to finally tame inflation and set the stage for the big market rallies we saw of the 1980s and 1990s. It took them almost a decade to get inflation back under control. And I lived through the 70s. I was a teenager, so I've got memories of gas lines and my mom complaining about prices and got to tell you guys, one of the worst experiences you'll ever have is when your mom, who could not cook a lick, decides that we're going to go in with meatless recipes one or two nights a week. Was not a fun time if you were an investor in the markets. You were getting fairly well clobbered on a regular basis. Only the deep value guys like Warren Buffett and to other degrees like Charlie Munger and Howard Marks, they had kind of a party because pricing got really, really attractive. But you had to be patient and you had to be disciplined because it took years for most of those stocks to recover. And we saw the Nifty 50, which is a lot like the ARK fund stocks of today, cratered, and many of those stocks took decades to recover the highs that they had reached earlier in the 70s before inflation got out and started running around. Are we going to go that far this time? I don't know. The Fed, even the minutes this last time, they finally started to show, some signs that they were a little concerned about this and maybe they'd accelerate the pace of bond buying and of interest rate increases. And, there is a fear actually that they'll go too far. And we'll see how all this plays out if, in fact, they can get inflation under control. Problem is, no matter what anybody's telling you, this is not all supply chain issues, guys, okay? There are signs now. We're getting wage inflation. We're seeing rents just skyrocketing out of control all over the United States. That stuff's not transitory. Rents aren't going to come down anytime real quick, and wages, once granted, are almost impossible to take back. They may be a little harder to blame. Even the government and all its fumbling manners should be able to eventually get the supply chain under control. Not so sure how they're going to do with wage and rent inflation. We'll see how it plays out. For now, the markets hate it. At the close today, the S&P 500 will be down, almost 10%, getting into correction territory. QQQ's probably between 17 and 18% off of all-time highs. And the Russell 2000 is getting really close to being off the 20% that would represent a bear market. How bad is it going to get? That's the question on everybody's mind. And I don't have a stock answer for you. High yield spreads are not showing me that there's a type of panic in the market that has historically represented a real buying opportunity. We've got a model that we use to measure, market levels using the number of exchange traded funds that reach certain readings on an overbought, oversold scale that we developed. No signal there except, believe it or not, for some muni bonds. So nothing there that tells us that the equity market is so oversold it's time to really get in there and start poking around. Now, I primarily invest in small bank stocks. Absolutely none of this or the Putin mess is impacting us in any way, shape, or form. We're up a little bit for the year. The bank stock indexes are up. Our main portfolio is up more than the indexes, in spite of the 35% cash level I think we carried into the year. So we've got cash to put to work as opportunities develop, and I think we will get opportunities throughout the year. A little bit of selling here, a little bit of selling there, but we saw a bunch of thrift conversions late in 2021. I'm hoping, of course, that we're going to see a bunch more, because getting money to work into those conversions at 70, 71, 72% of tangible book value has always worked out very well over time. So we're hoping we get a chance to do a bunch more of those. But because the community banks are almost an alternative asset class all by themselves, they're not impacted by these major market moves. They're the single best opportunity, in my mind, available to the individual investor today. You're literally playing a game where all the odds are stacked in your favor and the big guys cannot play. You have a consolidation theme in place that's been in place. It's going to stay in place. Going to see a lot of bank M&A deals this year. Already seen one. I expect a bunch more in the portfolio before we close the books on 2022. So that's kind of what we're looking at. Banks, by the way, in case you haven't figured it out yet, they like higher interest rates, especially when rates are moving higher from the extraordinarily low rates that we've had in place for the last decade. This is going to bring net interest margins up higher. Higher net interest margins is going to mean higher profits, which should ultimately lead to higher stock prices for banks, most of which are trading at ridiculously low multiples of asset value and of earnings. Bank PEs are still a fraction of what the market is trading at. So it's kind of crazy. So, as I look out at the broader market, I'm going to stick to banks. A couple other areas that I'm going to touch on here in a couple minutes. There's been an excess in the market for years now, and there is a too high a price for everything. I always love to tell the Cisco story. Cisco is a company that literally changed the world, okay, back in the 90s, and has continued to do so all the way up through as we sit here today. They're still one of the leading players in developing all the internet technologies that make the internet bigger, better, faster all the time. They're also going to be a huge player in cybersecurity going forward. Cisco has grown by leaps and bounds since they hit those internet bubble highs back in 2000. Guys, if you bought near those highs, you're not even yet. Now, I want you to think about that for a minute. We are many, many years away from the year 2000. I'm just pulling this up to see how much further we have to go here. And if you bought Microsoft at those levels, and Microsoft, one of the better companies on the planet, and not just my opinion, but a whole bunch of other people. And of course, now I'm having troubles with my other computer. It took you till 2015 to break even from those levels. So that's mildly problematic. There is a too high a price for everything. That's kind of the point of this. And I think we're sort of at a point right now where many of those high-flying stocks, they're really good companies, all right? Zoom, DocuSign, these are great. These are good businesses. But there's too high a price for everything, and I think we may have reached it for many of these companies for now. And by the way, you've got to add about 30 points onto the price of Cisco from this level to break even on your year 2000 purchase. That's a little tough. I think this year we're going to see some of the excess get wrung out of the market. This doesn't necessarily mean we have to have a crash. I'm not ruling it out. But really what I think the play is going to be is just kind of a long, gradual rotation from all these high price to sales multiple stocks with no earnings and great stories to real businesses. And that'll be, home builders. We're still short a bunch of homes. We need a bunch of inventory added to homes. Building's going to stay strong, I think, for a while. I think energy is going to be with us for a while. I'll touch more on that in a minute. But traditional. But I also think there's going to be some demand in renewable energy, certain pockets of that market. It's banking, of course, real business that benefits from inflationary pressures. I think the money's going to start to rotate around here a little bit. Another place I really think they're going to go. I think, guys, we're going to see a big move coming up. Maybe not right away. We're in a good time to accumulate the cannabis stocks. plenty of people out there that know more about the dope space than I know. But Alan Brochstein, comes to mind. This guy who really knows and understands this market. Here's what I know: the companies have gotten the what kicked out of them. They're getting down to levels where, they're getting cheap. The companies are starting to throw off cash flow. Selected companies, and when I looked around, I noticed that some of the old school white shoe research publications, Value Line, Morningstar, are starting to project massive long-term 3 to 5 year profits for companies like Grow Generation, Tilray, Kronos, Cureleaf, Canopy, Green Thumb. I love Kronos. I think that's that is going to be a 5-6 bagger. And legislation's not going to happen in 2022, guys. It's probably going to be 2023, and here's why. 65% of us believe that marijuana should be legalized for both medical and recreational use. I don't see a hell of a lot of difference between somebody, taking a couple bong hits and me having a couple of bourbons. I see very little difference between the two. Neither one of us should drive, but if we're home in our own living room, neither of them should be illegal, okay? But 35% of us don't think it should be legal. The 35%, they vote. It's an election year. It's a contentious, fractured, dogmatic election year where it's going to be a just literal street fight in some of these states between the Democrats and Republicans. And you can't afford to give up on 35% of the vote block that you're going to need to win this thing. So I think, there's a bunch of bills, by the way, in Congress, and I think they're all going to pass sometime in 2023. The safe banking bill keeps coming up. That one needs to come up. I mean, the state of Kansas has made a business out of seizing truckloads of cash that are coming out of Colorado heading for banks outside the region, and seizing them because the proceeds of a marijuana business, and Kansas has decided they're allowed to seize that. It's an interesting court case. It's something that can be dealt with by passing legislation at the federal level that deschedules cannabis and allows the states to make their own decision. That's the more probable outcome, is that we don't see the feds go, boom, it's legal everywhere. I think they're going to pass it down to the states and let them decide. Well, guys, the states need tax money, okay? They've legalized cannabis. They're legalizing sports gambling, and they're doing it because they need the tax money. They need new sources of cash to waste. It's very important to have that money coming in because they've got these grandiose budget ideas, and they've got a lot of money that they want and need to spend in order to stay in those nice cushy seats of power that they've won themselves over the last several years. And if that sounds cynical, it's because I am. I've read a lot of state and state agency budgets over the years, and quite frankly, it's hideous, the amount of waste that is at every level of state and local government. It's crazy. So I think that we will see most states pass cannabis in some form. I've talked to people who know the sports gambling and the cannabis business, and they all seem to think that eventually every state but Utah will have both legal so that they can just keep taxing it and bringing those dollars in. So anyway, I think that, cannabis is going to be a big business. Really looking at energy. We'll talk about that more next week because it's a long topic. It's one that's going to take some time to talk about in and of itself. So anyway, there's where we are. The big tech and the indexes are getting, they're taking a whooping. And I haven't seen anything get beat this bad since baseball season ended and the Orioles couldn't play anymore last year. So we'll see how it all plays out. I don't know how far down it'll go. High yield spreads, as I said, are not giving me this great all-in signal. Doesn't matter. I've got a buy list of more than enough community banks to keep me busy and keep me invested and keep me looking for opportunities and making me money. Interest rates are going to mean higher profits for most of the banks, if not all of them, in the banking on profits portfolio. And I think we'll continue to see as many takeovers as we did pre-pandemic, where we could have 12, 15 takeovers in the portfolio each and every year. We had like 7 or 8 last year in the main portfolio, and a few focus banks got taken over. So all told, I think we had 10 takeover deals in our portfolios for 2021. I think we're going to get back to more normalized levels with much higher numbers in 2022. So anyway, guys, this is Tim Melvin. I said I promise you I'm going to update the video equipment, but I think it's time we got back to getting a little video content on here and acting like we really were living in the 21st century. So anyway, guys, thanks for watching. I'll be back next week.